We just got a new inflation report yesterday, which said that core inflation fell faster than expected, and I wanted to discuss this. Core inflation is the Federal Reserve Bank's preferred measure of inflation, and it excludes what's called the volatile numbers, which are energy and food. And what it said is that core inflation now is at a 3.9% annual number. Now remember, the Federal Reserve Bank's target on inflation is 2%, and core inflation is down to 3.9%. Now there's a couple things that I want you to remember. First, inflation is kind of like wealth. It can compound. And what we've been seeing for the last number of years is that inflation has been very hot and very elevated, and it still is. And so even though core inflation has cooled down a little bit, it's still high, which means the prices of things that are rising are compounding on last year's price increases, and they're compounding on top of the year before's price increases. Inflation disproportionately hurts the average person. It disproportionately hurts somebody who's not financially educated. And so now, if we still are seeing hot core inflation, because 3.9% core inflation is still about double the target that the Federal Reserve Bank is looking for, that means that the average person is still getting poorer because of inflation, because most people's incomes are not keeping up with the higher cost of living. And I should also mention again that core inflation does not include food and energy prices. Now, the average person has to pay for food and energy prices. And what are we seeing happen around us right now? Well, we're seeing gas prices and energy costs go up. Part of the reason for that is because oil prices are higher due to OPEC plus cutting the production of oil. So we've been seeing oil prices rise. So now naturally gas prices are rising, and higher oil prices affect not just your gas prices, but they really affect everything, because gas is, or energy is, a vital component in the supply chain of products in the United States. If you're a farmer and you need to get your supplies, your produce shipped to a store, there's a cost for a truck to ship that product to a store. And one of those costs are energy. So when you have higher energy prices, that can really impact the prices of everything later down the supply chain. And this is where, again, understanding the inflation report and understanding how it applies to you is very important, because yes, according to the numbers, core inflation has fallen slightly. It's still very elevated, but the core inflation and the inflation that we're seeing compounds year after year after year. And then we have to talk about the economy, because Jerome Powell, when he was talking about inflation, talked about the hot economy and how that could affect inflation. And here's what he said. He said that, quote, "The heat that we see in the GDP, our economy, isn't really a threat to our ability to bring inflation back down to 2%. Well, that's going to be the question. It's not a question about the GDP in general, but the question is, will the hot economy make it tougher to bring inflation down? So what we're seeing happen in the economy right now is that people are still spending money. And the reason why that's a interesting thing is because people are losing out on the ability to spend money from their earnings. Because what we have seen over the last number of years is that inflation has outpaced wages. So the prices of things, your food, your housing, your groceries, your travel, your car, the prices of things have risen faster than incomes. So naturally, when you have the prices of things growing faster than how much money you're making, you would expect that people would have to cut down the spending, because your incomes are growing, but just not fast enough to keep up with the cost of living. But that's not what we're seeing happen. We've been seeing study after study talking about how the American consumer is resilient, about how strong the American consumer is. But this is where, I've talked about this, I know, countless times, but this is where it is so important to understand how our economic system works. And we have done so many deep dives of this on Market Briefs. Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the housing market, the economy, the stock market, the global economy, and crypto. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link to how you can join down in the description below, where you can go to briefs.co/market. Now, the way that our economic system works is it runs on spending. It does not care if you're spending money on your credit card. It does not care if you're spending money out of your 401k. It does not care if you're putting equity out of your home to spend money. All it cares about is how much money are people spending. And what we're seeing is that the costs of living are rising. It's still rising today. We saw a cooler than expected inflation number, which is still extremely hot, which means that the prices of things are continuing to compound on top of their already high prices. And if wages aren't keeping up, that means what is going to happen is people are digging into their savings. We're already seeing this happen. People are digging into the credit card debt. We're already seeing this happen. People are digging into the 401ks. We're already seeing this happen. And people are digging into their home equity in order to continue maintaining their lifestyle. We are seeing this happen. These four things are happening currently. And this is what keeps the consumer so resilient. So when you hear about consumer spending being strong, that means people are still spending money even though they don't have money to spend. What does that mean? Well, it means it's good for the economy today, but it's very bad for the individual, especially tomorrow. Because eventually, when you keep spending money you don't have, you hit a breaking point. Now the question is, when is that breaking point? And this is where a lot of people have different opinions as to when this breaking point is, but a lot of people are saying some point in 2024, you will see this quote unquote breaking point. Because now you're seeing student loans start to restart in, well, just around the corner. You have people starting to see the consequences of the consumer debt. Credit card debt just hit over $1 trillion. You have people worried about asset prices. And so this is where now, if people continue spending, that is great news for the economy today. That will keep the stock market moving, that'll keep everything going, but it is bad news for the consumer tomorrow. And this is where now the Federal Reserve Bank is talking about inflation relative to the economy. Because if people continue spending money like crazy, if people can pull cash out of their home, they take a home equity line of credit. Now they take this money and they go out and they buy cars, they go out and they buy clothes, and they go out and they buy vacations. What does that mean? It means the demand for these products and items stay high. And if the demand for these products stay high, that also means that the prices will continue to stay elevated. Why? Because when you have more demand than supply, that naturally pushes the prices of things up. If you have 10 buyers for one home that's listed for sale, and now these 10 buyers are trying to bid against each other by competing against each other to buy this home is going to sell for above asking price. And it might sell for a lot more above asking price depending on how desperate these buyers are to buy that home. So when you have a lot of demand with a limited supply, that pushes the prices of things up. And this is where now Jerome Powell is saying, yeah, a growing GDP is generally not a bad thing. However, when you have high inflation, that's where this strong GDP can be a problem. Now the question is, when will it actually be a problem? We've seen interest rates rise very quickly over the last 18 months. And the Federal Reserve Bank may raise interest rates again in 2023. They have said now publicly in September that they want to keep interest rates high through 2026. How high? We'll see what actually happens, but this is what they said. And if they continue raising interest rates, there's an effect to that. Now, this is where I want you to understand that raising interest rates historically has had an impact on the economy. The last 14 times the Federal Reserve Bank has gone through a rate hiking cycle in the United States. 11 of those times ended up in a recession. And so when you have a rate hiking cycle, it generally cools down the economy. Does it happen every single time? No. 3 out of the 14 times we did not see a recession, but 11 out of the 14 times we did. Now we should also remember that the last time we saw interest rates go up this quickly was in the early 1980s. And the recession that came after that was not a mild recession, it was a deep recession. The unemployment that we saw in 1982 was higher than the unemployment that we saw during the peak of the 2008 crash. So there are impacts to higher interest rates. Not to mention the fact that we still have a whole bunch of debt floating around out there. Consumer debt, yes, but a lot of that is fixed rate. Not all of it, but a lot of that. Corporate debt, most of that is not fixed rate. Commercial real estate debt, most of that is not fixed rate. And national debt, $33 trillion worth of national debt, which is not fixed rate debt. So now when you have interest rates rising so quickly, and a lot of entities that have been so reliant on cheap debt for the last 15 or so years, because for the last decade and a half, our economy and people have become very accustomed to very low interest rates. And now you start jacking up interest rates very quickly. Mortgage rates are now where they were in the early 2000s. It seems like a shock. People will say, whoa, a 7.5% mortgage rate seems unreasonably high. Versus if you look at it over the last 50 years, that's relatively low. But over the last couple of decades, yeah, that's really high. And so now when you have people accustomed to these low interest rates and you have all this debt that is adjustable rate at the corporate level, at the national level, on the commercial real estate level, that was taken on during the low interest rate period, when those debts go to readjust, there's going to be a cost to that. And that's going to be coming in the next 24 months. By the end of 2025, you'll be seeing more and more of that coming to readjust. But if interest rates stay high, there's going to be an impact to that. If the Federal Reserve Bank continues to raise interest rates, there's an impact to that. If inflation continues to stay high, there's an impact to that. This is why I keep saying 2023 is the year for you to get financially smart. This is not the year for you to go out and finance a new truck. There's a lot of emotions out there. The emotions will move the stock market up or down, but the goal isn't for you to get caught up in these weeds of short-term movements. The goal is for you to understand what's happening on a bigger level. That way you can find opportunities and be able to capitalize on opportunities and build wealth from what's happening around you. That means knowing what is your investing strategy. That means knowing when do you invest. That means knowing what to invest in. That means knowing how to invest. And that means having the ability, having the cash, having the money to invest. This is why it is so important for you to work on building that financial education, because what ends up happening every time you see a downturn, and downturns happen in the United States, we've seen a recession pretty much every decade for the last century, and we haven't seen a real recession in the last decade and a half. I mean, you could call the 2020 recession a recession, but that really wasn't a real recession. No one really felt any real economic pain during the 2020 recession. So we haven't seen a real recession in a decade and a half. We've seen a recession pretty much every decade for the last century. We know recessions happen. Well, this is where, again, it pays for you to understand what's happening, because anytime you see an economic downturn, people panic. They start to point fingers. They start to blame. They start to say, I never saw this happening. They start to everybody gets very emotional and angry when you see things go wrong. When everything is going up, no one's having an issue. Everyone's happy, everyone's making money, and everyone's just saying, haha, why would you prepare for something wrong when everything is great? But this is where the goal isn't to be worried or panic. The goal is just to be financially educated and prepare for everything. That way you can win when the market's up, and you can also win when things are going down. But that requires you to build that financial education. That also requires you to be financially prepared.